Stop. Do not panic. Do not touch your position. I know exactly what this feels like. Silver hit $91, a 3-week high in the previous session. And now it is Thursday, February 26th, 2026. The price of silver is at $87.07 at the open, down $3.68 overnight. A 4% drop in less than 24 hours. The forums are filling with one question: is 80 next? They want you to believe the rally is breaking. They want you to believe the profit takers have won. They are wrong. This dump is not the death of the structure. It is a calculated ambush by the same hands that always raid the metal on first notice day week. The 6th consecutive year of structural deficit does not vanish in a single session. Ladies and gentlemen, analyst here. Let us take apart this move piece by piece. Silver is heating up, and this move could surprise the market. Let's break down what's happening right now. If you want clear and powerful silver market updates, make sure to like, subscribe, and follow Alex Carter Reports for the latest analysis. To understand whether $80 is genuinely in play after today's 4% drop, you have to understand the price structure that silver built over the 4 weeks leading into February 26th. And that structure tells a story sharply different from the panic narrative circulating today. The base of this entire recovery was forged at $63.85, the low after the January 30th war shock, described by market trackers as silver's worst single session since March 1980. From that low, silver rebuilt a rising parallel channel that began at approximately $73, according to analysts tracking the February 26th price action. That channel produced a 5-week advance: 73, then 80, then 84, then 87, then the spike to 91 on February 25th. Today's 4% pullback to 87 is not a breakdown. It is the metal returning to the channel midline. It built over 5 weeks of disciplined recovery. Exchange data confirms the structural context. The 1-day return registers negative 3.98%, but the 5-day return remains positive 15.95%. The 1-month return is negative 13%, still absorbing the war shock aftermath. Year-to-date, silver is up 27.26%, and the 1-year return is positive 178%. This is not a metal in a downtrend. This is a metal in a short-term consolidation within a historic bull structure. The critical levels define the $80 question. Analysts note that immediate channel midline support sits at $87.64, matching today's trading zone. The 50-period and 200-period moving averages are converging at $84. The narrow gap between them signals a tightly compressed momentum base. The RSI has retreated from overbought territory to the mid-50s, which analysts note gives buyers room for another move without significant reversal risk. This is not a damaged structure. This is a structure that released pressure at 91 and is cooling to equilibrium before the next advance. The $80 level itself is the battle line that matters. Reports confirm silver successfully flipped the $80 zone from resistance into formidable support during its February recovery. The 50-day simple moving average sits at $80.87, described by analysts as the most critical level to watch. As long as silver closes above that mark, the bull structure from the $63.85 low remains intact. Sources note the supply zone at 83 to 84 serves as a decision area. A rejection there targets $81.18, then $79.70, then 76. That is the path to 80, not the path from 87. But here is what the bears are missing. The February to April 2021 silver correction offers a direct historical parallel tracked by market analysts. After a sharp initial rally retraced, silver stabilized near pre-rally levels, and then over the subsequent 48 days rose approximately 19%, from $24.05 to $28.63. The same structural pattern is in motion now. The $91 spike was the exhaust release. 87 is the reset. The 48-day clock is now running. According to analyst forecasts, the next 7 days alone are projected to produce a 4.53% advance, returning silver to approximately $92.19 by early March. The weak hands see the 4% drop and calculate 80. The diamond hands see the 48-day clock and calculate 100. Today's 4% drop is a paper price event layered over a physical supply reality that has not changed by a single ounce. Begin with the most consequential number in the silver market right now. Reports confirm the Silver Institute projects a 67 million ounce structural deficit for 2026, the 6th consecutive year of global supply shortfall. The 2025 deficit alone was approximately 95 million ounces. The cumulative 5-year deficit from 2021 through 2025 has now exceeded 800 million ounces, the equivalent of 1 full year of global mine production. Not a single ounce of that cumulative shortfall reappeared in the physical market because silver dropped 4% today. The structural deficit is not a price phenomenon. It is a geological and industrial reality that trades do not alter. The supply-side anatomy explains why the deficit cannot be quickly closed. Reports confirm that approximately 75% of silver is extracted as a byproduct of copper, gold, lead, and zinc mining operations. This creates a structurally perverse dynamic. Higher silver prices do not motivate mine operators to produce more silver, because silver represents a small fraction of their total revenue stream. Sources note that higher silver prices can actually reduce output as miners shift to lower-grade ore that was previously uneconomical for its primary metal content, inadvertently shrinking silver byproduct volumes. This is the supply trap that keeps the 67 million ounce deficit permanent, regardless of whether silver trades at 87 or 110. The solar substitution thesis is real but overstated as a near-term bearish factor. Reports confirm LONGi Green Energy Technology announced plans to replace silver with copper in back-contact solar cells, targeting mass production in Q2 2026. Jinko Solar and Shanghai Eiko Solar Energy are executing similar roadmaps. But analysts note that copper introduces assembly cost increases and reliability concerns. The dominant TOPCon cell technology is less compatible with copper-based alternatives due to high-temperature fabrication requirements. The Silver Institute acknowledges the thrifting is happening, but projects only a 5% year-on-year reduction in photovoltaic silver demand for 2026. That still leaves an active 67 million ounce deficit for the year. And silver's share of solar module production costs has risen from 3% in 2023 to an estimated 17 to 29% per watt today, a price concentration so large that manufacturers are under genuine pressure to adapt, but the engineering timelines for mass copper adoption span years, not quarters. Reports confirm that Boeing flagged a $1 billion supply chain headwind, largely attributed to the rising cost of silver aluminum alloys essential for modern fuel-efficient airframes. When aerospace is absorbing $1 billion cost impacts from silver prices, the industrial demand base is broader and more price inelastic than the forums acknowledge. The BHP Wheaton Antamina streaming deal reveals how institutional capital is positioning for the continued structural deficit. Reports confirm that BHP received $4.3 billion upfront from Wheaton Precious Metals in exchange for decades of silver production from Peru's Antamina mine, the largest streaming transaction by upfront payment in the industry's history. This is not a bet on a temporary price spike. This is a generational capital commitment structured around the expectation that silver's structural deficit will persist long enough to make decades of streaming revenue worthwhile. Sources confirm Wheaton's stock has gained 93% over the past year, partially bolstered by this deal's addition to its portfolio. When the world's largest mining companies and streaming institutions are making $4.3 billion commitments to silver's future, today's 4% paper drop registers as noise. The February 26th sentiment picture is the most revealing of the entire rally cycle. When you examine who is positioned where and what the data actually shows, the narrative of a weakening market collapses under its own contradictions. Begin with the commitment of traders' positioning. Reports confirm the February 20th COT data revealed a record short position in the SLV silver ETF building at precisely the moment gold was breaking above $5,000 to new all-time highs. A record short bet against silver, placed at the peak of silver's historical relative strength versus gold, after the gold-silver ratio had already compressed from 100 to 1 in April 2025 to approximately 45 to 1. The most aggressive paper short position ever recorded in SLV was built by traders betting against a metal in its sixth consecutive year of structural deficit. This is not intelligent capital responding to fundamentals. This is leveraged paper positioning running out of time. The retail sentiment data confirms the tourist exodus is complete. Reports confirm Reddit chatter around SLV this week scored at 40.59, neutral territory tilting negative, yet the price was climbing anyway. The weak hands who entered during the January 26th viral fear period and exited at the crash bottom have already been flushed from the market. The retail community is now predominantly bearish or absent. This is the sentiment signature that historically precedes the next institutional accumulation phase. When public sentiment turns negative and price action turns positive, the buying is coming from patient, well-capitalized sources that understand the structural thesis. Those sources are not worried about $80. They are loading positions between 83 and 87. Sources confirm SLV closed at $71.01 on February 20th, an 11% recovery over the prior week from the $69.72 bottom. SLV now sits 13.82% above where it started 2026, but still 12.67% below where it traded 1 month ago. This spread describes the profit-taking anatomy precisely. Investors who entered in early 2026 are profitable for the year. Investors who entered in late January near the $91 to $117 zone are still underwater. The February 26th 4% drop is those investors continuing their exit. not new bearish capital entering, old leverage capital still exiting. That process has a natural end. And when it ends, when the last weak hand has sold, the structural bid from institutional capital and industrial end users reasserts itself. Sources citing Bank Julius Baer confirm the most accurate diagnosis of the January crash. Once profit-taking started, it just snowballed. The same mechanics are operating today at a much smaller scale. The $91 three-week high attracted the same quick flip crowd that participated in the January 26th peak. They bought the run to 91. They sold the 4% drop to 87. The metal finds support at the channel midline because the structural buyers, the ones accumulating for the 67 million ounce annual deficit, are waiting exactly there. At 87, the institutional signal is unmistakable. Reports confirm analysts at Citi maintained a target of $150 per ounce within 3 months of late January's rally. JP Morgan's own research projects silver averaging $81 per ounce for 2026, still above the current price level. And Bank of America expects gold to hit $6,000 over the next 12 months, a trajectory that historically compresses the gold-silver ratio and drives silver higher in parallel. The paper short position is record-sized. The institutional price targets are vastly above current levels. The resolution of that tension is not $80. Here is the complete bear case for $80. Present it honestly, then dismantle it with data. The bear argument has 3 pillars. First, the Warsh-hawkish pillar. Kevin Warsh, nominated as next Federal Reserve Chair on January 30th, is widely understood as a hawkish institutionalist committed to a smaller Fed balance sheet. Reports confirm markets treated the Warsh nomination as a pivot toward aggressive monetary tightening, a signal that the era of accommodating liquidity, which drove the debasement trade throughout 2025, faces a definitive challenge. A hawkish Fed strengthens the dollar. A stronger dollar raises the cost of silver for foreign buyers and increases the opportunity cost of holding a non-yielding metal. Sources confirm the nomination triggered silver's worst single session since March 1980, a 31.4% collapse in futures in a single day, as leverage positions faced margin calls simultaneously. If Warsh is confirmed, with his first policy decision likely arriving in June 2026, the interest rate trajectory tightens, placing the monetary portion of silver's rally at structural risk. Second, the U.S.-Iran resolution pillar. The third round of Geneva nuclear talks is underway today, February 26th. Reports confirm Iran has proposed a 7-year limit on uranium enrichment in exchange for full removal of secondary sanctions. If a preliminary framework is achieved, the Geneva stalemate risk premium that silver and gold have been carrying evaporates. Sources confirm explicitly that a successful Geneva resolution could ease geopolitical risks and reduce safe haven demand, potentially weighing on silver prices. The third pillar of silver's current price support, Middle East escalation risk, would disappear in a single headline. Third, the solar substitution pillar. With silver now accounting for 17 to 29% of PV module manufacturing costs, the commercial pressure on LONGi, Jinko Solar, and ICO to accelerate copper-based alternatives has reached a tipping point. If Q2 2026 mass copper adoption arrives on schedule, the single largest industrial consumption category begins its structural retreat. Now the counter to each pillar. Warsh confirmation timelines do not intersect with the May delivery campaign. Reports confirm his first policy decision arrives on June 17th, weeks after May's first notice day creates its own structural supply test. The interest rate channel may not even tighten if macro data weakens before then. Bank of America's $6,000 gold target over 12 months is consistent with continued dollar softness regardless of Warsh's appointment. The monetary pillar of silver's rally is not the only pillar. The industrial and structural deficit pillars operate independently of Fed policy. The Iran talks counter. Reports confirm the U.S. delegation demands comprehensive dismantlement of Iranian enrichment capabilities, far beyond the 7-year limit Iran has offered. Historical patterns suggest these negotiations rarely resolve in a single round. Sources note the primary near-term price catalyst remain U.S. durable goods data Thursday, and the Producer Price Index Friday domestic economic data, not a Geneva agreement. The solar substitution counter. Analysts note copper-based panel production faces assembly cost increases and reliability risks. The TOPCon technology stack dominates current deployments and is less compatible with copper. The 5% year-on-year PV silver demand reduction already projected by the Silver Institute still leaves the 67 million ounce annual deficit intact. And the byproduct supply trap means mine output cannot be increased to close the gap regardless of what solar manufacturers decide about their cell architecture. The bears have 3 arguments. Each one has a specific, quantifiable expiration date before it invalidates. None of them invalidate the 67 million ounce structural deficit. None of them replenish the 800 million ounce 5-year cumulative shortfall. And none of them add silver to the vaults. The floor is 87, not 80. The battle plan for the $80 floor defense. February 26, 2026. Silver at $87.07. The 5 price levels that define the next 60 days. Level 1, $87. February 26 equilibrium. The channel midline established over 5 weeks of recovery. Immediate support confirmed at $87.64. A closing hold above 87 tells you the 4% drop was a reset. A closing break below 87 warns the decision zone is next. Level 2, $84 to $83.60. The decision zone. Sources confirm the 50-period and 200-period moving averages converge near $84, the coiled spring. Analysts identify $83.60 to $84 as a critical supply zone. A break above this level activates momentum toward 86 to 89. A rejection and breakdown below targets 81 and then 79. If silver reaches this zone in the next 5 to 10 sessions, it is not a catastrophe. It is the accumulation opportunity. The spring being compressed one final time before the May delivery campaign begins in earnest. Level 3, $80.87. The 50-day simple moving average. The structural defense line. Reports confirm this is the most critical level to watch. As long as silver closes above $80.87 on a weekly basis, the bull structure from $63.85 remains intact. A weekly close below this level is the only scenario that makes the $80 bear narrative credible. Watch the weekly close, not the intraday dip. Level 4, $91.27. The resistance neckline. Analysts confirm this is the key resistance level that must be cleared for the next structural advance. A clear break and weekly close above $91.27 activates the measured move toward $95.23. Sources confirm the next major harmonic resistance sits at $92.30. A sustained close above $92.30 before Q1 ends sets the stage for a retest of the all-time high. Level 5, $110. The measured move. Reports confirm analysts have identified a cup and handle formation with a neckline at approximately $84. The measured move target from that neckline is $110. This is the convergence zone for the May delivery campaign, the 67 million ounce structural deficit, and the industrial demand floor under which physical users refuse to allow sustained prices. Not 80, 110. Scenario 1, 87 holds. Thursday U.S. durable goods prints weaker than expected. Friday PPI undershoots consensus. The dollar softens. Geneva talks stall on enrichment scope. Silver holds above 87 through the weekly close. The 48-day clock from the post-correction parallel begins its advance. Analyst projections point to 4.53% in the next 7 days, approximately $92 by early March. The neckline at 91.27 is tested and cleared. The May delivery buildup begins driving the next institutional accumulation wave. Diamond hands who held from the crash accumulate between 83 and 87. Scenario 2, 84 decision zone. Geneva achieves a preliminary framework. Dollar firms. Silver retreats toward the 83 to 84 supply zone. This is the second gift, the accumulation zone that the 48-day clock requires before its advance. Reports confirm Hecla Mining's all-in sustaining costs sit at $11.01 per silver ounce after byproduct credits, delivering extraordinary operating leverage even at 84. First Majestic doubled its dividend to 2% of net revenue at current price levels, signaling mine-level confidence that $80 silver remains commercially viable. The structural floor is below the bear's 80 target. The spring compresses. The May 1st notice day ignites the next advance. Your question for the comments, with silver dumping 4% from $91 back to 87 today. Do you believe 80 is the next destination, or is this the final shakeout before the May delivery campaign drives the advance toward 95 and 110? State your conviction level in the comments. This is Analyst here. The floor is being tested. The structure holds. Stay stacked. Stay sharp. That's it for today's silver update. The market is setting up for a potential big move, so stay alert and stay prepared. If you found this analysis helpful, don't forget to like the video, subscribe to the channel, and turn on notifications so you never miss an update. This is Alex Carter Reports, bringing you clarity in every market move. See you in the next one.